Hello everybody, it's April 10th. Welcome to our weekend edition of what's happening in the market. On the S&P 500, we had a bearish looking pattern. If you look at the weekly chart, we would dare call this an evening star pattern, where it would be a reversal pattern. We had this little bull run, got rejected at the 462 level, and then we finished the week lower. Now we did develop this little range right here between 450 and 443, and a break above 451, we're bullish again. What I like to see, or what makes me feel good about this motion, this action right here, is we had this declining volume on selling. As you could see here, anytime you see volume increasing during a sell-off, that's going to intensify the sell-off. Every time you have increasing volume during a sell-off, you're going to have a continuation of the sell-off. Well, over here, or this past week, we had declining volume during the sell-off. There was a lot of positioning, a lot of trying to get ready for the best month of the year, which is April. We all know April is one of the best months of the year. So even though on the weekly chart we have a bearish pattern, if the bears break below that 443 level and break below that 50-day moving average or 50 period moving average on the weekly, then we become bears. And as day traders, we don't have a preference whether it's up or down. If we break below that, we play the downside. If Monday we open up and continue to push towards this 450 level, we play the upside. That's what we do as day traders. We put our personal preferences aside and we play what the chart is giving us. You could see on the sector rotation, the XLE, XLU, XLV, which is energy, utilities, and healthcare, are leading the charge. All three of those are up for the year. The XLC, XLY, and XLK, which are communication, consumer discretionary, and technology, they're not just on the bottom of the list, but they're also down for the year, and they're down significantly for the year. Some of the things that's happening in the stock market is you could see a very good you could see the shenanigans that happen in Wall Street, where the job of the market makers is to try to make as many people as possible feel as if they don't know what they're doing. So as soon as you get these rallies and a lot of people start buying calls, then they get this hard pullback, and a lot of people switch back to bears, and then we'll likely have a hard uptick and kill all those bears, just like they killed all the bulls on this downturn over the last week. On the chat, I keep talking about max pain. If you look at max pain for the week, this is the second week in a row that we closed where the most amount of contracts are going to expire worthless. You see all this put volume over here. All these over here we'll just dismiss, but you have all this put volume right here, and all this call volume, and all of those contracts expired worthless because the market makers know that if the close at 477 was just going to kill the most amount of contracts. The Nasdaq doesn't look any better than the S&P 500. On the weekly chart, it still had that evening star pattern. The risk range for the week is 341.29 on the low side and 369.79 on the high side. On the daily, we still have this big gap to fill up to 361. I don't know that we're going to bounce up and close that really quick. You could look at this in several different ways. You could be optimistic and say that we just started a new channel going this way, and we're at the bottom of the channel, and we're going to bounce up. That's a very optimistic way of looking at it. A different way to look at it is to say that we're going to play inside this range right here until we have some good news. The Russell 2000 isn't giving us any information. It's not giving us any patterns, any good indicators for us to form a a direction. The main thing that I see here is if you look at last year, we had this Wyckoff distribution movement, we had the false breakout, and then we had the drop that we saw. If you look at it on the daily, you see the same type of distribution. You see the same type of false breakout and then a drop. If that drop continues and tests the lows at the 188 area, I do think we're going to drop to fill this gap down here around 165, 166 level. The Russell 2000 isn't giving me confidence for a bounce in the market. If we look at specific stocks, we had Tesla, which is to me is a big indicator of what's happening in the market. We had it fill the gap. So we could argue that the big drop in the market was just for a lot of these stocks to fill the gaps that they had left 2 weeks ago. Now that it's filled the gap and it's stabilized right there, a drop below the current level at 1,025 is going to take us straight down to 950 on Tesla. But a recovery there is going to jump us back up to the 1110 support that we've had. Apple is at the same spot where it's in a support area. We closed right at that 20-day moving average, we bounced right off that 20-day moving average. The upper risk range on Apple for the week is 175 and the lower risk range is 158. You could see that in Tesla, we had that max pain right at that 1,025 area where all these puts were going to expire worthless and all these calls were going to expire worthless. And just like the SPY, we closed right at that 126 area, 125 area where a lot of the options were going to expire worthless. Apple, same general story. You have all these puts right here, all these calls over here. Apple closed at 170.09, which is right in the middle of the max pain area right here. This is as obvious to me as it possibly can. The market makers are doing a great job of controlling the price action, of making sure that as many people feel as if they don't know what they're doing as possible. The market doesn't look gloom and doom to me. I see a lot of negativity in the market right now. A lot of people are frustrated. The bull-bear spread is turning more bearish. There's a lot of talk of recession. There's a lot of talk of inflation being out of control and the Fed not being able to control it. So just a little macroeconomics lesson right here. I don't want to take too much time away from your day, but we have CPI, which is a measure of inflation. And then we have PMI, which is a measure of productivity. When the PMI is above 50, it's a sign of expansion. When the PMI is below 50, it's a sign of contraction. We're at 62.9 right now. So we're not at contraction, even though we are headed towards contraction. We're not there and we're not near there. We're on the upper half of the spectrum. But something that I wanted to point out right here on the PMI is there's always history always tends to play a part. One thing that's interesting to me is when you look at history, we're going to look at a couple of dates right here. This is February of 69. We had the PMI peak out. And if you look at the CPI, which is the inflation, January of 1970, you had the CPI peak out. So you had productivity, you had the market output, the strength of the economy peak out in February of 69, and then you had inflation peak out in February of 1970. And then in November of 1973, you had the PMI peak out again. And then the CPI peaked out again in October of 1974. That's almost exactly a year later. So that's two key points where it peaked out exactly a year later. The third one is going to be April 1979. You had the PMI peak out, March 1979, and you had the CPI peak out. So this 3 times in a row where PMI peaked and then 1 year later CPI peaked. Well, why is that important? It's important simply because we are in a very news-driven market. And the way I see the charts right now, I feel like we are one good news away from popping to the upside. So PMI peaked out in May of 2021. If we get a reading in May of 2022 that shows us that our inflation has peaked out and we get our first contraction in inflation, that's going to set the market into another bull run. There are signs of recession in the future, but there's always signs of recession in the future. The bears have this way of telling people that there's gloom and doom and the end of the world is coming. But the signals that we have say that inflation is about to peak out. And once we get those news that inflation is about to peak out, then we're going to get the S&P 500 rallying back up to test the all-time highs. I hope this helps you out a little bit. I hope this gives you a little bit of hope that there's good news about to come. The midterm election years are very driven by news, and you could see it in the volatility that we've had this year. But if you join us in the Discord, you'll get a lot of information that will guide you towards making good decisions. We'll let you know what the market rotations are happening, and we'll together become successful at trading. So join us on the Discord. If you like the content, give us a thumbs up, like the channel, and share it with your friends. Have a good weekend, and we will see you on the chat.